Hi, good afternoon, everyone, and a very warm welcome to this webinar. Wishing you all a very happy new year. So, as we reflect on the past year, 2023, it brought a mix of global and domestic experiences, some sweet and some bitter. And as we step into 2024, we obviously hope for a more nuanced journey. So, in today's session, we will delve into a few noteworthy scenarios, starting with the highlight of this edition, which would be a case study on the notable uptick in corporate margins. Moving on, we will try and understand the rationale behind central banks contemplating rate cuts, not just the when, but the why. Also, taking a closer look at India's economy, we will discuss how we recognize a bit of a slowdown. However, it appears to be handling the situation with more caution compared to what we see globally. Further, there will be some discussions around specific sectors. So, Sahil will be taking us through all these data points in detail and help you develop a more comprehensive perspective around it. Also, during the course of the presentation, if you guys have any questions, there will be a question answer tab on your screens, and we will collectively take the questions towards the end of the presentation. Over to you, Sahil.
Thank you, Pragati, and Happy New Year to all the viewers. So this is our first webinar on Netra for 2024, and we'll straight away dive into what we are, seeing. This could slightly be longer because we have a case study. So as Pragati said, we will be covering a number of topics today, starting with a case study on valuations and then, opportunities. So largely, there has been a large uptick in corporate profitability across the world, specifically in US, and we will deep dive into what has happened and then take the ramifications from there. And in the second half, we'll talk about domestic markets and what are the opportunities we are seeing. So first, let's start with our case study, which is on corporate profitability. So this case study is specifically targeted towards one specific narrative. What is that narrative? That post COVID, what we've seen is that in US, corporate profit margins have gone up significantly. You can see if you look at this blue line, and this data is from 1980. You can see this is probably the average. US corporate profitability on an average is around 12 to 13%. These are pre-tax corporate profits, and as you can see, the trend has been, one of rising corporate profits in the 21st century. There has been largely two very large declines. One was during the global financial crisis, and then in the aftermath of COVID, also we saw a very sharp decline. Largely, corporate profits have been stable around this 12-13% mark. But as you can see, that corporate profitability accelerated quite quickly and went up to about 19%. Okay, and so this large uptick in corporate profitability from about 15-16%, pre-COVID highs, and during the quarters prior to COVID, corporate profit margin was close to 13-14%. And then it jumped about 400-500 basis points. And largely it has come down to about 15%, which is still very, very high. You can see in comparison to history, the only second peak that we saw was prior to global financial crisis. That was also 16%. So profit margins have been very strong. Even after declining, they're at 15%. So the narrative is that corporate profitability has gone up so much, and it has sort of reached a very high number, and it can continue to be here. And therefore, global markets have also depicted very similar trends. Even if you look at Indian profitability is at record high. In many other countries, it has been depicted where price performance have been very strong. And so a strong expectation has been built that this corporate profitability is here to stay, and it will continue to help companies report very strong profitability. And this has been, helped by a number of new terms that we hear on a daily basis. For example, the Magnificent Seven in US, very large seven companies which are now contributing about 31-32% of market cap in US, right? And big becoming bigger, etc. We've seen these terms take hold, largely a reflection of this very, very strong corporate profitability growth. The question that we ask is this sustainable, right? And in this cycle, a lot of commentary has come about saying that this is a new normal, and therefore corporate profitability is going to be very high, and therefore stock market performance is going to be exceptionally strong, right? we will deep dive into what are the reasons why this corporate profitability has gone up. So if you look at this second slide, this talks about two components, which are the cost component. That means what does when you look at the top line, what are the two major cost component which takes out from corporate profitability? That means they are subtractive in nature. That means they reduce corporate profitability when they go up. So one component is what we call government component. It include taxes on production and imports, less subsidies. So subsidies has been reduced. That means added back to corporate profitability. And this line, if you see, there are two lines on this screen. One is the actual line, this red line. This is the cost component for corporates because of government, right? That means the taxes they are paying on production or the imports that they are making, and the taxes therefore they are making on those imports, etc. So largely a reflection of how much taxes they are paying overall. And you can see this component, the red actual line, has been quite stable. That means contributing about 9% as cost and reducing corporate margin by that effect. And when COVID happened, you can see this cost declined from about 9% on an average to about 3.5%, right? This sharp decline on the left-hand side scale, you can see, a sharp decline in this cost component. And this decline was completely matched by the subsidy that the government gave. What kind of subsidies did the US government did during the crisis? So enacted a number of programs like coronavirus aid, CARES Act, paycheck protection program, etc. There were a number of total programs. The total cost was between 8 to 10% of GDP, right? Which is a very large number, right? So nearly about 2.5 to $3 trillion just in these savings helped many of these companies protect their margins because cost declined, right? And the another component which helped cost decline and therefore boost corporate margins was reduction in net interest cost, right? So you can see this red line is the net interest component cost. That means what is the amount of interest that corporates are paying. And that also declined significantly to an all-time low. This series is at all-time low right now as we speak. What were the causes of these two numbers coming down? One was, of course, the fiscal stimulus that the US government gave. Very large fiscal stimulus, aided by all the programs that I spoke about earlier, right? COVID Act, CARES Act, Paycheck Protection Program. And those numbers were very, very strong, and they protected corporate margins anywhere between 3.5 to 6%, depending on what is the size of company we are talking about. Second component, which is the net interest component, why did was this very low? Because US Federal Reserve enacted one of the biggest monetary stimulus or monetary policy actions that we have ever seen. It gave one of the largest quantitative easing program. The US balance sheet more than doubled in a matter of a year. That means there was one particular quarter or about a 6 months period where the US government borrowed 3 trillion and the US Fed infused $2 trillion, right? In one 6 months period, which was a very large boost for corporate margins and reduction in net interest component. These two explain about 80 to 90% jump in corporate profits post the coronavirus pandemic. And what is the status today? And that will also answer our question number one, whether these corporate margins are sustainable or not. So if you see that post-pandemic, two programs are enacted. If you see this red line is the expansion in Federal Reserve balance sheet. That means Fed started printing money and it started going up. You can see to tackle the COVID pandemic, I have written it here. The government borrowed and spent nearly 10% of GDP. You can see these blue lines going down. That means government borrowing was going up significantly. And the US Fed increased its balance sheet, by 70%, all in a matter of 5 months. And this, gave a huge fillip to corporate profitability, as I showed you, both reducing the cost component and reducing the interest rate component. As things stand today, which is one of the most important, questions to answer, monetary policy has completely reversed. Federal Reserve is no longer sitting at 0% interest rate. It is at 5.5% Fed funds rate. US government has reduced its borrowing, although not as much reduction as it does in prior cycles. So it is still borrowing some amount of money. So fiscal stimulus is not completely over, but for smaller companies, it is more or less over. But from an economic perspective, there is still some seeping in through of very large borrowings, but it is getting unbound, right? Post March 2024, it is not entirely clear whether the US Fed, whether the US government or the US Treasury will continue to borrow like it is doing right now, right? That means that there is a possibility that it can slow down on borrowing and therefore slow down on spending. So if you look at these two aspects together, fiscal stimulus is reducing, already reduced, although not completely gone. Monetary policy has completely reversed. Quantitative easing has given way to quantitative tightening, and interest rates which were zero is at 5.5%, which is a 30-40 year high. Which means if you go to the last two slides, both the factors which allowed corporate margins to go up significantly have now reversed. One completely reversed. Monetary policy has reversed so much that we haven't seen such tightening in 20-25 years. Fiscal policy not completely reversed, but reversing as we speak, as we go along. What is the overall impact? So when you look at what could have been the counterfactual margins, that means had this stimulus not been given, what could have been the natural progression? Margins which have already declined to pre-COVID levels as things stand today, but they're still higher, as you can see, right? That means as the monetary policy and fiscal policy is unbound, corporate profitability in US will go back to where it used to be prior to COVID, right? And it will again become a dynamic of how strong or weak the business cycle is. If we are in a recession, the profitability will be lower. If we are in an expansion, profitability will be higher. But it will fail to remain where it is right now because the two large drivers of corporate profitability will probably be behind us, right? This also tells you that this new normal or new narrative that the world is seeking right now, that it may not become available. And second thing is that if you look at, let's say, US S&P 500 is trading at about 20 and a half times 12 months forward multiple, which is roughly 400 basis points away from its long period average of about 20-25 years, which means that on a price to earnings basis, markets have discounted this new normal. It expects these higher profit margins to continue, which to our understanding, this data tells us that it will be very, very hard. You need another different event or probably a larger stimulus for these programs, like these programs, for this corporate profit margin to continue, which means that markets have probably given or discounted a lot of future growth at a valuation level which far exceeds the historical average, which makes them more vulnerable, right? And where this has happened, if you look at, we talk about Magnificent Seven and large cap companies. If you look at this chart on your screen, it has three lines. One line is largest firms, their corporate profit margins. The blue lines, and these are all listed firms. The blue line is for large firms, and the black dotted line is for median firms, right? Median sized or medium firms. And what does it tell you? The largest firms are the top 20 percentile or of quintile, sorry, not percentile, quintile of the overall distribution. That means the top 20% firms. And you can see the larger firms have seen record corporate profit margins, and the difference between corporate profit margins of large firms versus small firms has a difference of about 6%. This also explains why a broader market index like Russell 2000 has underperformed an S&P 500 or a Magnificent 7 by such a large margin, right? There is a huge difference between the performance. If you go back to the Netra publication of last month, you will see this particular slide depicted in terms of price performance of indices, right? And you will see that this depiction is very clear. What does it tell you? That smaller companies have been hit particularly hard because of the coronavirus crisis. Their margins recovered because of stimulus, and as soon as the stimulus went away, their margins have again declined. For larger companies, the uptick was significant. They delevered significantly. Their margin profile has not deteriorated so much up until now. But as and when you remove the stimulus, their profitability will probably go back to their long period average. And that also will cause some of the larger companies also to see deceleration in profit margin growth. And this is for the listed universe, and it will probably be reflected in stock prices if it comes true, right? On the overall scale, it is quite clear that these numbers are contracting. Can it happen the other way? That means for smaller companies, margin can increase and they can make a comeback. For now, there are no signs of that happening. Largely, most of the universe, will possibly converge to a lower number, if at all, right? And therefore, it makes a lot of sense for looking at all these companies in light of history, right? The next one is how are current numbers shaping up? So, in context of the last 4 or 5 slides that we spoke, so I gave you three, four insight. One, very high corporate profit margins post COVID, driven by very large both monetary and fiscal policy stimulus. Both are now behind us. Monetary policy completely reversed, fiscal policy slowly reversing. It possibly can reverse at an accelerated pace in the second half of 24, largely when US elections are close or over. And third, we think that these very high elevated margins are unsustainable. They will probably settle at their long period average, if not below. And now we'll look at what are the current numbers. So we plotted three things: world export price growth, which takes into account volume and price both; S&P 500 revenue and revenue sales revenue, and money supply in US. As you can see, money supply and the world export growth both have already slowed down. You could also check world export volume, right? Not just price. Volume has also slowed down to about 0% YOY growth. And that is the export volume, world export volume growth, right? That has also slowed down to 0%. Money supply is already contracting, which is the largest contraction that we have ever seen since the data is available. And that tells you that the S&P 500 sales revenue growth, which is still growing, there is a possibility that it will drop, right? So if you put two and two together, margins are already declining, and top line growth is already expected to decline. In the past, monetary money supply and world export growth has largely been a lead indicator of sales growth. When both of them decline, usually sales growth also declines. When sales growth declines and corporate profit margins are stable or falling, earnings growth becomes very, very challenging, right? So you can, put this into context that if earnings growth become challenging, the market will directly question what should be the multiple that should be offered to the market. Roughly it can't be between 1.5 standard deviation higher than the long period average. So that will become a very difficult price to earnings multiple or valuation multiple for the market to sustain. And that, I think, is the contention going ahead. Third, again, very, very important force which is acting on a broader scale is where are we in the disinflationary, inflationary scenario, right? So last 2 years we saw very large, after COVID, we saw a very large uptick in inflation globally, and now we've seen globally inflation has sort of fallen. And specifically in case of China, it has become deflation. In many other countries, inflation numbers have fallen to not pre-COVID levels, maybe 100 basis points higher than that, and possibly they are slowly and steadily coming down to those levels. Now the question is, if money supply growth has already decelerated, world exports have already slowed, PMI indicators across the world have started to contract. Can inflation continue at this heightened pace? Can it uh, come down close to 0%, 1%? That will contribute to even further slowdown in top line growth, in sales growth, which will become another headwind for companies to report higher profits. And this we think is possible, at least in data, it is happening right now, and we'll be able to get more color as we progress towards April, May, June. As this data becomes more entrenched, we'll be able to see the overall impact. As of now, it does appear that these forces are acting lower. That means these numbers are falling, and that also gives you a perspective that corporate profitability will find it very tough to continue. Another very important aspect is that in every past rate hike cycle, whenever Federal Reserve has hiked rates, it has ended with some kind of a event, right? We don't know whether it will happen this time or not. One mini event we saw in March 23, which was the SVB crisis. Another event happens or not, anybody's guess. But the contention is not predicting an event or credit crisis or anything. Nobody can do that. What we are saying and looking from history is that the Fed starts to cut rates when they see trouble in the market, right? Usually, when unemployment rate is very low, inflation is falling, the propensity of the central bank to cut rates aggressively is very low. So, for example, the market is right now talking about one rate cut, two rate cut, four rate cuts, depending on who you speak to, right? So, just imagine that Fed funds rate is 5.5% today. If the Fed were to do four interest rate cuts, okay, I'm just it's just an expectation. I mean, I don't have a ballpark figure whether it is one or four. Uh, um, it's just a conjecture. Let's say they would do four rate cut. That means 25 bips into 400 basis points of rate cut. Fed funds rate falls to 4.5%. It remains at a 20-year high, right, or about a 17-year high. So even after such a large quantity of rate cut, monetary policy will remain fairly restrictive in US, and that means that uh, very large rate cuts, which we have seen in the past, have largely been a reflection of more emergency needs by the Federal Reserve. That means if they do not enact rate cuts, there is a possibility that the economy continues to slow down, or if they enact very high interest rate cuts, that will only be a response to a crisis. Whether that crisis happens or not, we have no idea. The history says that sharp rate cuts are not a norm when economy is fine and no crisis happening. They become very, very slow, which means that the market will also become very, very lethargic or consolidative in nature if the Federal Reserve does these very small piecemeal cuts over a period of time, or if they do not do any rate cuts, that is also a possibility, right? If inflation takes an uptick, that will continue to put pressure on, cost of capital, on the ability of the economy to grow at these fast pace that we've seen over the last 2, 3 years. So in both the cases, it will be very hard for stocks to continue to trade at the multiples they are trading. And historically, we've seen, as I said, when Fed cuts rate, usually it is a response to crisis. And this chart shows you that whenever Fed has cut rates in the past, S&P 500 has fallen sharply, 33% in the post the dot-com bubble, and 50% in global financial crisis, about 12% when Fed started cutting rates and ended. The markets also bottomed, of course, but during that point, from start to end, it fell about 12% during COVID, and then it recovered. It fell much more from top to bottom, but we are just looking at dumb data on how much it fell when Fed cut rates, and eventually it rallied, right? But the point is that usually very large rate cuts are a response to some kind of a crisis. And this also means that, looking at interest rate cuts and making a positive hypothesis is possibly very, very hard. And we have shown that in the past that rising interest rates are usually a reflection of economic strength, and they play out in the advantage of stocks unless rates have become too high where they are right now, right? And they cause some amount of pain for equities because cost of capital goes up significantly. So we'll be a lot more skeptical in terms of why rates are cut rather than thinking about because rates are cut it is positive, right? So the reason for cutting rates is going to be the most important aspect as we move into 2024. And I have noted down here what are the price to earnings multiple that we have today in US S&P 500, 14.5%, from 27th October low. I have highlighted some points here that over the last 3 months, S&P 500 has rallied only in response to increase in valuation. Earnings, of course, is yet to go up. Quarterly results are yet to be published. Maybe the sequential increase in EPS will be 1.5%. But the price increase that we've seen over the last 3 to 6 months, not only in US, across the world, is largely a reflection of re-rating. That means valuations multiple has gone up, PE multiples have gone up. Why have they gone up? The market has started to expect rate cuts. And why does PE multiple go up when rate cuts are expected? Because people believe that cost of capital will fall and it will contribute to more profitability. But as we see, as I've shown you in the last 2, 3 slides, the history is not very kind, right? Historically, we've seen very large rate cuts. Usually, they impact corporate profitability from the angle of events or financial risks that emanate from financial markets, and not from just corporate profitability perspective. So just to summarize this section and then move to India, corporate profitability in US has been very, very high, and we believe that it was a function of both fiscal and monetary stimulus. Both these stimulus are now behind us. They are more or less over, and corporate profitability has already started declining. Profit margins, uh, margins are declining across the market capitalization curve, and also we are seeing money supply growth, export growth are slowing down, which means that top line, which is sales growth, can also come under pressure, which is a very large input for profitability or EPS growth. uh, Inflation slowing down will also put pressure on top line growth. And if margins are contracting, it will not allow corporate profitability to rise as much as it has post COVID, right? And historically, we've seen very large increases in interest rates by Fed has culminated into some sort of crisis. We have no idea whether a crisis can happen or not. We don't have any clue. There are no indications, of course. But historically, we've seen that rate cuts of very high magnitude happen only in response to crisis, right? And therefore, expecting that interest rate cuts will be a reflection of a market rally would slightly be misplaced. When we look at the history. Now we'll deep dive into where we are domestically and what are the factors that we are looking at. Domestically, we look at all high frequency indicators. When you look at the GST numbers, we are seeing slightly flatlining of growth. The YOY growth number has now fallen to about 10% or so. It could be seasonal also, but more or less we are seeing that strength will come down. Even when you look at the RBI forecast, H1, which is first half of FY24, we grew at about 7.7. Full year numbers are closer to 7% or so, which means that in second half we'll grow at 6.5 or lower, right? Which means that even expectation from the central bank is that growth will slow down in FY24, and similarly is reflected in most indicator. E-way bills numbers have started to cool off. Petroleum consumption has flatlined, as you can see, for the last few months. Toll collections have started to show a dip. Business activity index, which were at all-time high, whether it was manufacturing PMI or services PMI, they have come down a tad, but they're still very, very healthy in a very strong zone of expansion. But they have started to come down, and possibly they could come down even further as you read the commentary. Second, as you see, excluding consumer discretionary and financials, excluding these two sectors, the top line growth has started to come down to about low single double digits, except these two sectors, right? And as you can see that this growth number, which was much more stronger in the prior quarters, between mid double digits to higher double digits, or even higher, has started to slip lower. In some cases, it is accelerating, like healthcare has started to make a comeback, but in most other cases, it is slowing down. So top line growth is slowing down. Second, as you can see, profit margins, and let me spend 2 minutes on this slide because it is very, very important. So this blue line, if you see, is the net profit margins of listed companies ex of financials. So we've removed financials from these companies. And the black line is India WPI minus CPI. That means the wholesale cost minus the retail cost. So as you can see, whenever the black line goes up, corporate profit margins follow it, right? They also move up. And as you can see that when the India WPI minus CPI declined, corporate profit margins also declined. Now what we are seeing is that the full impact of the last increase, that means CPI fell later than WPI. WPI has been in the negative territory nearly for 6 months now. CPI was higher. It has started to come down. What is the dynamic here? The input cost, let's say the wholesale price is the proxy for input cost or the raw material cost of corporates. And CPI, which is the consumer level inflation, is sort of a proxy for the sale price for the corporate in a very crude manner, or the end product prices. When the CPI reduces and gets closer to WPI, usually you will see corporate profit margins will also come down. So currently, corporate profit margins are at one of the best place that they have ever been. And there is an expectation that they will decline as we progress into this quarterly earnings, which will start from tomorrow. and we'll start seeing a reflection of how corporate profit margins pan out. Our expectation is that from this and next quarter, we'll see margins slightly, gradually, slowly coming down, and that will also hit our profit margin growth, EPS growth, so to speak. FY24 growth is likely to be 20-21%, but in FY25, the growth is about expected to be just about 12%, and which will be reflected in reduction in corporate margins, right? And as you can see, when this reduction happens, I showed you two slides. One, sales growth across the sector is slowing down. Corporate profit margins are at record high. They are also at a juncture where in the next few quarters they could slow down. And where are the markets trading? They are trading at trailing multiples of 23 times, forward multiples of 21 times or so. Our premium over other emerging markets, which is India's premium, is about 73%. Our long period average is 37%. So we are at 2x the premium to other emerging markets. A market cap to GDP, not a great indicator, but we are still way above the long period average. And most of the stocks in NSE 500 are above their 200 DMA, which also tells you that market breadth has been very, very strong. All the stocks have been lifted higher and re-rated higher. So which means that markets are trading at rich valuation. Whichever way you look at it, they are beyond their average valuations at a time when sales growth and margins are peaking and sales growth is coming down, which means corporate profitability could get compromised in the next few quarters. So, what is the takeaway from these three slides? It tells you that market will find it hard to continue the pace at which it has risen, and possibly we'll see more consolidation or a large correction, which will bring back these valuations to more sober levels from where they are right now. A few sectors. One is technology. We've seen tech stocks rally when US rates expectation cooked in that rates will be cut. Nasdaq rallied, even Indian stocks rallied. But if you see very closely, these stocks have rallied to levels where post-COVID peaks were, right? So as you can see on all accounts, I have taken three indices here: Nasdaq, Nifty IT, and Semiconductor Index. All three are closer to the peak valuations that we saw post-COVID. And although there is still some room to go to that level, but their sales momentum and profitability is not as strong as it was during that period. So they are clearly slightly overheated, and there could be a period of correction consolidation in this sector. Second is where the good opportunity lies in terms of the upside. We are looking at banks and pharma here. And this ratio, let me explain that the blue line here depicts the banking sector divided by the NSE small cap index, right? The bank index or bank nifty divided by the small cap index, and the red line shows the pharma index divided by the small cap index. And as you can see, there are phases there for about 4 years, for 4.5 years, and now again for 4 years. The banks and pharma sectors have underperformed the small caps, right? It could be a reflection of very strong sentiment and rally in smaller caps, small cap companies, and the tail end of the market, and these sectors not performing as well. But we've seen that there are three cycles very similar in nature, very similar in timing, and we are again at that juncture. Why do these two sectors? One, both of these sectors are seeing very strong sales growth, strong margins. They are also available at better valuations compared to the tail end of the market or small caps or micro caps, right? So it makes sense that from market cap perspective, they appear oversold. From valuation perspective, they appear to be in a better range compared to the broader market, and therefore we believe that a mix of large caps and these sectors, and maybe a very small dose of very good valuation oriented broader market mid and small caps could be the better portfolio mix, largely focused on these two sectors. We continue to see opportunities which are available in these two sectors as we go ahead. The last is on gold, and one simple explanation of what has happened in gold. It may not be correct. This is possibly a justification. So what we did is that we looked at US debt and gold prices. We normalized them from the start date in 1993, and as you can see, as US debt, which is the blue line, it started to go higher. Gold prices have sort of followed the acceleration in US debt. And there are times when gold prices underperform the acceleration in US debt. That means US keeps on borrowing money, and gold also performs, but sometimes it underperforms that growth, right? And at times it outperforms. And these periods of underperformance and outperformance are coincidental with strength in the dollar or the weakness in dollar. So if the dollar is very, very strong, you will see that the gold prices will underperform the accretion in US debt. And if dollar is weak, the dollar index is weak or sideways, gold prices will outperform significantly. So over the last 10 years, what we've seen is that even when US has significantly increased its debt, specifically after COVID, you can see gold prices did respond, but the dollar has been exceptionally strong, which has not allowed gold prices to move higher. Uh, our understanding is that if dollar was to weaken or become sideways as it did in this period, there is a good possibility that gold prices will break to a lifetime high, and this possibly is going to be a trigger for gold prices to do well. As of now, they continue to remain above that threshold of 2100. They have not been able to clearly breach that resistance and hurdle and move higher, but they are slowly catching up from 1900 to 2000 now, hovering between 2050 to 2100. If there is an episode where dollar remains sideways or declines overall, then the underlying mechanics for a stronger gold rally are already in place, right? And we can talk about this further as we dive into question and answer. So I will possibly stop here with this last slide on what if, where we have no idea what kind of risks are hidden. And one very, very important fact that low prices they always come with bad news, right? So our ability to act on market corrections is restricted, because when market corrections happen, they also happen to be accompanied by bad news. And when market rallies happen, they are often accompanied by great headlines, great news, and we end up using that headlines as a justification to add to equity exposure. And on the other hand, when markets decline and we hear a lot of bad news, that becomes a justification for avoiding stocks. We believe that doing the opposite is more logical. That means if you are seeing a massive rally in stocks accompanied by great headlines, it is time to recalibrate our exposure. And when the correction occurs and you see huge bad news, take an informed decision, probably raise your equity exposure appropriately.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.